everyone is having an awesome morning, and we're really excited for an incredible panel on alternative finance. This morning we have review of creative and efficient, unique sources of capital beyond equity to grow and generate earnings. This is going to be an awesome session moderated by Ron Suber, who I'd love to invite up to introduce the other two panelists. So enjoy Denver Startup Week. Sign up for multiple sessions, attend often, and have a frickin' blast. We've got really, really great content on this stage and the stage below all day, and enjoy, enjoy, enjoy. Ron Suber.
Good morning. So Roy and Brian, come on up. So this is going to be a very interactive session, and I really hope that you're going to ask questions from our panelists who were entrepreneurs and are now helping entrepreneurs with different types of capital. And I'd like to take a very quick poll before we get started. Can I just see a show of hands? How many students do we have in the room? I know we have a couple. So maybe 12 over there. We have any students here, one in the back. How many people have a business that are entrepreneurs today, that you are battling it out to run your business today? So we have a lot here. Awesome. And how many people want to start a business, that you want to be entrepreneurs, soon to be entrepreneurs? Awesome. And how many people work for a giant company like Amazon or JP Morgan or someplace like that? A couple. Okay. No. Okay, good. So let me just start out. I was an entrepreneur for many years and absolutely love this conversation. This is something that you may or may not have heard of before. And so I really encourage you to take notes, because there are 2 or 3 things, or 4, you're going to learn from Brian and Roy about what they do and how they help entrepreneurs that's different than most of the things you've read about, that all the venture capitalists talk about. It's very, very popular. So let me just start with you, Brian. So who are you, how'd you get here, and what do you actually do every day to help entrepreneurs with your unique form of capital?
Yeah, well, thanks for having me. Thanks, everyone. Brian Parks, so co-founder and CEO of Bigfoot Capital. We started about 8 years ago to provide non-dilutive capital, i.e. debt, to B2B software companies, some of which have raised traditional venture capital, equity, many of whom have not. They may be bootstrapped, or they may have found other ways to capitalize their company along the way. Prior to that, so I moved out to Denver in 2006, kind of got into the entrepreneurial world in 2010, I guess. Eric Matisik right there, who introduced us. It was I joined his company in 2010 as employee 1, along with him and his co-founder. So prior to that, I did about 4.5 years of investment banking, which is relevant to this conversation, doing mergers and acquisitions transactions outside of tech. And so then got into tech, and it was all raise angel money, raise venture money. That was kind of it, right? Kind of the options, capital options had really truncated to those 2 things, whereas the world in which I'd been operating outside of tech had a lot more capital options. And so was a next great place with Eric, then ended up starting a company called Brandfolder here, based in Denver, was the founding CEO of that business. And for all of these companies, that was the first company I started, Bigfoot being the second, did a couple of other things. We were always raising capital, and it was always equity capital, angel or venture. And at Bigfoot, I still have to raise capital, be it equity or debt. It's not all my money, unfortunately. So, I think that's my backstory. I'll stop there.
Hey, everybody. So, Roy Mabry. I'm a partner at General Catalyst, specifically working on the Customer Value Fund. I came out to Denver in 2018. I've actually spent most of my career on the operating side. So I was the CEO of a company called Life Factory. We sold glass water bottles with silicone sleeves, you might have seen. And then I was at Palantir before coming to General Catalyst. And what we do is a little bit different, I think, than probably anything you've heard of in terms of a financing product. I like to say I sell money to growth companies. We saw this opportunity where you'll hear a lot about equity. There's a lot of good times to raise equity. I think VCs will talk about them and how they've marketed themselves. But what we saw over and over again was companies get to a certain stage where they figured things out, they're humming along, but all of a sudden they have to keep raising money over and over and over again. And so we saw an opportunity to kind of help them with that problem, where we specifically invest in the sales and marketing of companies, or the customer acquisition cost, or growth, whatever you want to call it. But what's different is we then take the risk of that sales and marketing performance. So we only get paid back if the company gets paid back by the customers they're trying to acquire. So what that does is it lets a company, one, just improve their cash flow. So if I'm giving you all of your sales and marketing spend up front, obviously you don't have to spend that out of your own bank account. But two, it allows you to be a little bit more aggressive on how you think about growth, because if somebody else is taking that risk for you, you can kind of go out and experiment a little bit more and try and grow a little bit faster.
So that's really the first takeaway for today is, as entrepreneurs in your current business, if you're using your equity venture capital dollars to fund your marketing, you might want to think about using debt instead. And that's really one of the takeaways we're hoping you leave here with. There are other ways to fund your business other than the equity dollars you raise by giving up a percentage of your company. So let's just back up 1 second, and then I'm going to ask you, Brian, to talk about a success story in just 1 minute. So the entrepreneurs in the room started off with their friends and family, and they went and said, I have an idea, I want to do this, this is what the product does, this is what the service does, I'm going to put in $10,000. Do any of my friends and family want to put in money? And then you give them a piece of your company. They actually give them equity, and they get their money out first. Whoever puts money in gets their money out first, and employees get it second. And then as you grow and you get product market fit, you go for a seed round or an angel round, and then A, B, C, and all of that. And so you hope at some point to exit, right, with some IPO or someone buys you, and then you all get your money back in some return. And so the whole key of entrepreneurship is to sell without giving up all the equity. So we see a lot of entrepreneurs who sell, but they get very little because all the investors got the money out. And so this, again, this use of debt is non-dilutive ways where you keep your equity and you get to grow or acquire or market to build your business. And at the end, you just pay back the debt, but you get to keep the proceeds of your company. So that's really what we're trying to hammer home here today. So Brian, tell us a success story without saying the name of the company. How did it work? What did you give them? How did you get your money back? And how did it help that company get to the end zone?
Yeah, there's a number of them. So we've been fortunate to work with 54 companies, 40 of which have repaid us in full via some event happening. 36 out of those 40 actually paid us because something happened. So, there's one it's a company called Zonos based in St. George, Utah, which does not get a lot of capital coverage, I would say. There's not VCs popping into St. George every other day. Salt Lake's different. But this was a company that had been, prior to us coming in, operating for 8 to 10 years, maybe, pretty much in bootstrapped format. He had kind of pieced together a little bit of capital, but had been building a really nice business along the way, somewhat under the radar in St. George. And so, I think we ended up lending him $1 million initially, and then we increased it to $2 million, and then he raised his first institutional financing round was a $70 million Series A. Obviously, he paid back our $2 million as part of that. And and I hope it's going very well for him. But I think, and that was probably at a $300 million post. So he still retained the lion's share. I'm sure he got a good amount of secondary out of that as well. I literally remember when we were upsizing his facility, he's like, hey, can I take a distribution of $500,000 to buy a house? I haven't owned a house. I've got like 4 kids, because he was just pure entrepreneur mode, bootstrap mode. We were like, yeah, that's fine, man. You seem like a good steward of capital. So that was a great outcome. We've got many, many others whereby companies have even just totally skipped that and not taking that path. And there was a female entrepreneur we worked with down in Dallas who built a very nice HR tech company and was considering her options, growth equity, whatever it may be, and sold it to a strategic, and now lives on a ranch in Wyoming. And we diluted those 54 companies in aggregate 0%.
So that's the point. This is all about how do you grow, how do you win, how do you keep the equity, and then pay back the debt and go on your way to your next thing or your next life. So Roy, tell us a success story without necessarily telling us the name of the company. How did somebody win and succeed and grow by taking money from you to pay for their marketing and not get diluted instead of using their venture money for that purpose?
Yeah. So we've worked with a little over 40 companies now. So there's a lot to pick from. I think, to give you an example, we were working with a B2B SaaS company, and when you make decisions about how you're allocating the cash you have in your bank account, you have a lot of different things across your business you have to spend on. And then you have to make a decision of, am I going to spend that money in a way that I'm burning the capital? So obviously, if you're operating your business, you have all these costs that you're spending, you're collecting money from your customers. But if that money that's coming in is less than what you're spending, you have a certain amount of time that you'll look at, like, how long can I burn capital before I run out? And so you're making a choice about, like, how comfortable you are extending that runway, or spending more aggressively and maybe hoping that you can get another source of capital before you completely run out. And so what we see all the time, and in this particular example, is we'll see a company that is making a choice about how much they spend on sales and marketing, based on how quickly they think they can get paid back by the customers that they're bringing in. And so you'll see these statistics all the time: a 6-month payback, a 12-month payback, a 24-month payback. And when they make that choice, the reason that they're making that decision around sales and marketing is because that's sort of the one part of their business that's truly discretionary. If I have a group of customers that is in, and I have to operate and make them happy, and keep sort of the lights on and keep the product running, those are all things I have to spend on no matter what, or my business goes away. And then I make this choice of, now how much more am I going to spend than that required amount to grow? And what we saw with this particular company is that they were making a choice that they would spend to get paid back in 12 months. And they were spending a couple $1 million a month on sales and marketing. And they said, we can go out and confidently get paid in 12 months. That gives us about a 24-month runway. We don't think it's a great capital raising environment. We feel safe there. What we said to them was, most of the B2B SaaS companies that we see are more likely to spend to a 24 or 36-month payback because the products are so sticky, and you guys don't have a lot of churn. Your customers really like what you do. So you're leaving growth on the table by only spending enough to make sure you get paid back in 12 months. There's marginal opportunities of customers you can acquire if you spent a little more money. Maybe they take longer to pay you back, but you would be growing faster. And so what we're able to do in a situation like that is we say, hey, why don't you extend your runway? Why don't you extend your payback period from, let's say, 12 to 24 months, like this situation? So instead of spending $2 million a month on sales, you can spend $4 or $5 million a month, but we'll provide 80% of it. So you used to be $2 million out of pocket to get paid back over a year. Now you're going to spend $5 million on sales and marketing, but we're going to fund $4 million of it. So you're only going to spend $1 million out of pocket. So your actual cash burn went down, but you're now getting 2.5x on the sales side in terms of what you can do as you go to market. So think of how many more customers you can go out and acquire. And why this is really important is most companies in their growth stage will have some competition. They'll have a market that they're going after. They'll have a window of opportunity to go acquire it. So if you're too conservative, somebody's going to beat you there. Because if the customer needs the solution, they're going to buy something. And if you're not the one in front of them, then you're not the one that's going to get bought, and that's an opportunity that you may have lost forever. So in this case, this company was able, over time, obviously not overnight, but they were able to grow their sales and marketing, but do it in a cash positive way so that they actually started building their balance sheet while growing more quickly. And so that kind of became win-win for the company and investors.
And so that's another point we're hoping that you take away from this session at Denver Startup Week, is if the goal, or one of the goals of each of you in starting companies or running your companies, is to grow with quality earnings and generate cash flow and EBITDA earnings and exit, these are some of the ways. These are some of the tricks that the most popular companies are using. And you may have thought before you got here today that equity was the only way. And one of the things we've learned as entrepreneurs, and I'm going to ask Brian and Roy a couple more questions before I open it up to everybody, is you have to pivot in your business. Amazon, Uber, Airbnb, everybody pivoted from the original idea. And so if you think the only way you're going to fund your business is equity, maybe this concept of debt or non-dilutive creative debt is one of the pivots you'll make on your entrepreneurial journey. I'll just take a 1-second break here. Does anybody have a question for the panelists before I keep going? Yes, right here, please.
With these two examples, can you share with us what were the criteria or the prerequisites? Like, do you have to have cash flow or already some customer traction before you decided?
So what is the criteria you use in order to give the money?
Yeah. Similar, but quite different, probably. For us, we think it's very dangerous to lend money to companies too early. So for us, that's going to be a $2 million minimum revenue business. And, so 2 to 15, kind of on a median basis, these are probably $5 million revenue businesses, some of whom have raised equity along the way, some of whom have not. And we're writing them anywhere from kind of $1 to $5 million term loan facilities, credit facilities. So that's where we play, and then there's a lot that comes along with that. And I'd say a lot of these companies that are at 5 million have taken north of 5 years to get there. So we're not, things take time. We understand that, and it takes time to build a real business. We don't require cash flow. Oftentimes when we enter a company, they are burning cash. They're still investing into growth. So he says generate earnings. Earnings are wonderful. We very infrequently see them in a materially consistent way, unfortunately. We'd love to see them, every company, generate earnings. I think oftentimes within software what we see is, well, if I'm generating earnings, why would I need to borrow money? And it's like, do you understand outside of tech that you can only borrow money if you generate earnings, by the way, or have assets? So there's a lot of financial education, which isn't a bad thing, that comes along within this sector to include with the VCs who have to understand how to use debt for their portfolio companies. And we don't require that you are venture-backed to get that from us.
Yeah. So we're mostly doing mid to late stage growth stuff. I would say what's unique is, this might sound bad, but we sort of don't believe in GAAP or traditional accounting or finance when we think about how a company generates cash. I think a lot of the things that you see people working to from an accounting standpoint and how they think about different metrics or things like that have been sort of artificially created for good reasons at different points, but gotten people to make decisions in ways that sort of limits the ultimate opportunity. And so what we try to do when we talk to companies is like, how can you maximize your enterprise value? Because ultimately that's the goal. So we don't want you to hit a near-term EBITDA target. We want you to think about long-term, where is my opportunity to build the biggest company possible, because the opportunities to acquire customers exist, right? So we're often encouraging companies, instead of like hitting like nice looking like debt metrics like an EBITDA multiple that Bank of America is going to give you 2x and whatever, like we don't think that way. We're specifically looking at how much money is a company spending on customer acquisition, how long does it take them to get paid back, and how much more do we think they can spend on customer acquisition if we help them. We are later stage though, so we're typically start working with companies that are spending $1 million a month on customer acquisition. I would say the bulk of the companies we work with spend 5 to 15 million a month. We have one that spends 35. So think of us as like kind of this fuel to the fire once you've figured things out and are ready to grow.
So here's another takeaway that we just heard from the great question and the excellent answers: metrics and KPIs. So all the students write down these 3 letters. What are the key performance indicators that the money people ask from the entrepreneurs? And what do the entrepreneurs need to understand about the key performance indicators from the money people? Interest rate, how long, how much, and all that stuff. So KPIs between the 2 groups is another really big takeaway for those people wanting money and those people wanting to grow. Like this question right here in the back. Just repeat the question.
Yeah, so the question was, is debt not a good option for seed funding? And what are some other options? There's a couple of ways to go after this. I'll take a step back and then kind of answer how I think about it. If you were to come up to me and say, if you give me $10, I'll give you 20 back. I'd say like, okay, like a little fishy, but by when, and I'd think about it. If you came up to me and said, I'll give you $10 and I'll give you 10,000 back. If you give me $10, I'll give you 10,000 back. It might take me a little while, but I'm going to give you 10,000. I'd say that seems like it's worth the risk to me. $10, I got it in my pocket. 10,000, that would be nice to get. The reason I'm telling that story is what I think people have to think about is when they think of a source of capital and they think of what their ultimate use is for it, like where they're going to spend it, you need to think about what the return is you're generating, both as like a multiple on the original capital coming in, but also as the timeline. So if I'm founding a company and I'm starting it from scratch, and I say, there's a huge opportunity here. There's lots of examples of super successful companies in the space I'm going into. I'm clearly going to generate a return. It could be a really big return. I'm not sure how I'm going to get there. And then you go and you use a source of capital that requires it to be paid back in 12 months. That's a mismatch. That's an asset liability mismatch, because the sort of asset, the cash that you're taking in creates a liability that you have to pay back within 12 months, but you're founding a company that might take 10 or even 20 years to be successful. So in that case, you're going to want to go look for a risk capital where it's going to be more expensive. They're going to require a percentage of ownership, and that means it's a percentage forever. It's essentially an uncapped price. But that capital doesn't have a timeline that has to be paid back legally, and so you're able to go experiment and take like a longer time. What you're also going to see is that there's parts of your business as you're getting off the ground where the return actually does have a shorter timeline or a more predictable timeline. And so in that case, then you're going to make a choice of like, I raised this equity financing, it was really expensive, there's so many things I need to spend it on, but I also have to go do this thing that's going to pay me back in 2 months, but like I still need to bridge the gap cash flow wise. In that case, there are other options available to you if you can prove that there is sort of that faster return and payback. And so what we encourage people to do is just think about, what is my use? Like, what do I need this cash for? And like, what are the assets of my business, and what are the timing of how they pay back? So accounts receivable is a traditional thing that you can borrow against. And accounts receivable is essentially you've invoiced the customer, they're required to pay you that invoice. There's a lot of banks that will go and lend against that and give you that capital up front, so you don't have to wait. And so then by taking that cash in faster, you don't have to use the equity capital on your balance sheet. The way that we look at it with sales and marketing, and what's like a bit unique about the product, is we think about that as an asset similar to accounts receivable, because you're essentially investing in the future cash flow coming from the customers you bring in. And so when you grow and as you grow and at different stages, if you only consider equity capital for every source or for every use of spend within your business, that's going to be really expensive because you're going to have to raise an awful lot of it. But it doesn't mean that it's not an important part of the capital structure or something that you're going to need to raise. Like, you absolutely will, and there's really a lot of good reasons to bring equity into your business.
Yeah, I mean, that's kind of the part of the segment of the market that we occupy. And so it comes to, well, what's your definition of seed? Is it you're generating $1 to $2 to $3 million of revenue? You could argue that unless you're a Gen AI company, you're not raising a Series A right now unless you're generating $2 to $3 million of ARR with very strong growth. Could say that, not a Series A equity investor, but I think that's somewhat a reasonable statement. So, or are you a seed company just because the last financing round you raised was a seed and it was 5 years ago and you're at $5 million of revenue? So I think there's just a big dispersion of what a seed company could be. For us, it comes back to the revenue. And time in business. So have you been doing this for at least probably a few years? Probably the youngest company we've ever worked with was 2 years old. There's a lot of learning to be done and mistakes made and traction to call upon with time. It just takes time. And so that's back to, I think it's super dangerous to try to borrow any meaningful amount of money too early on in a company's life cycle, because it has to be paid back. And to Roy's point, maybe it has to be paid back in 6 or 12 months, maybe it has to be paid back in 2 years, but it's not equity that truly has no maturity date. So I would just be careful of that, while saying that, yeah, it could be an option from someone like us, from someone doing factoring or invoice financing, AR financing, credit card, SBA loan. Like, there are options. You just got to understand what comes with each of those options and what the expectation is.
I think we had a question right here.
Yeah. In these situations, how much was the cost of capital and payback period?
Cost of capital and payback period?
It's all situation dependent. The way that we think about our payback is we look at, and again, this is like if your cohorts of customers pay back a lot up front versus a lot over time, or there's different curves, there's like lots of things that can affect pricing. But the rough rule of thumb for the way that we price is it's about 0.1x or 10% per 12 months of payback. So if your customers on a gross profit basis pay back your customer acquisition costs in 12 months, you're going to return 1.1x to us, the original capital, is a rough rule of thumb.
Yeah, we could think of it in a conceptually similar way. So typically our payback is 36 months, and typically you're going to pay only the interest for a period of time, and then you start actually paying back the loan. And we're looking for something in the range of kind of 1.35 to 1.55x over those 3 years through a combination of interest rate and any kind of fee attached to the facility.
Question here?
What's the underwriting of the company's ability to actually efficiently take their sales and finance it? How do you look at that?
Just repeat the question.
Yeah, the question was how do we underwrite a company, by underwrite, obviously we mean how do we decide that we can invest in the company, and how do we decide if their return profile fits in a way that they could increase their sales and marketing, or how do we come up with that calculation? So where most of the team that I work with are just math geeks. There's several Palantir engineers. There's a couple people that were top of the India math tests they give at the end of high school, and so they're basically just doing a math problem in the background. And we've now looked at hundreds upon hundreds of companies, so we've got a lot of data by which we can understand what to expect at kind of different spend levels for different profiles and different cohort curves and things like that. So essentially what we look at is a couple basic things. It's one, what is the historical spend level? So like what's the actual data that we have? What's the actual proof on what the company's been spending? What have they been returning? Meaning how fast it gets paid back. But then we also look at how long do the customers stay with the company after they've paid back the original acquisition cost. So if you're, once you've kind of gotten to a growth stage and you've figured things out, hopefully when you're spending to acquire a customer, they're paying you more than you paid to get them, or else you're not going to be in business very long. And so, we talked a lot about payback period, but there's this other concept of lifetime value where you think about, on average, how much am I getting paid for the lifetime of the customers that I've brought in? So we'll look at, and that's a hard number to know because sometimes you don't have enough history. It's usually pretty variable. There's lots of estimation. But there will be data around how long people are sticking around and what churn rates look like. And over time, is my average payment increasing or decreasing because of churn? We look at all of that. And so then we'll just do a math problem of you've spent X, you've gotten paid back in time period Y, but the customer sticks around for time period Z or for amount Z in total lifetime value. And then we decide how far we're willing to go beyond that current payback period towards that ultimate lifetime value, and say, if you guys were getting paid back in 6 months, but you have a lifetime value of 24 months, we might underwrite you to 12, 15, or even 18 months of payback period, which then allows you to spend 3, 4, or 5x what you're spending today.
Do you want to say anything?
I'll chime in really quickly. Yeah, so all this stuff, again, we operate at a much earlier stage, I would say, from a scale standpoint, and certainly from a sales and marketing spend standpoint. So back to data. I think what we do is, we like math. We're not, as smart as these guys, certainly on the math front.
I don't do the math. I have to talk about it.
You got the people that do the math. So I think for us, it's a lot more art. I mean, it's not amazing art, but just to say you have to go beyond the pure fundamentals and quantitative aspects of these companies. We do something that's more akin to an equity underwrite. That's the way that we approach it. So while we're not hammering people on TAM or expecting hockey stick growth rates, we are caring about the team, the product, the market. We're talking with customers in our diligence process. We're talking with the equity sponsors. It's a pretty comprehensive underwrite. And yeah, like if it's a heavy sales and marketing driven go to market with a lot of spend, that starts to feel, SaaS companies do it too, especially within the SMB, SMB oriented SaaS or consumer. That's not something we're overly comfortable with, frankly. We don't know it that well, never been there as an operator. So we're generally funding team growth, hiring, ongoing product development. Yes, sales and marketing, but sales and marketing as a percentage of the overall spend for these companies may not be as high as it is at the growth stage. And maybe it shouldn't be as high as the growth stage. Oftentimes we may be funding, kind of that initial sales and marketing spend. They don't have a VP of sales. They've, maybe proven out one channel to some degree, but it's not fully baked. It's definitely not maxed out, and they may be testing a second channel. So, we're taking that equity-like risk with debt capital.
So before we get to the next question, I just want to put a pin on this last conversation. As you're presenting as entrepreneurs, either with new businesses or existing business at seed stage or later, you have to understand these aren't just pretty faces with money to hand out. They have math geeks and other people going to crunch the numbers and investment committees. You really have to have a good, crisp story on why they should give you the money versus give it to somebody else. What does the loan tape look like? What are the metrics? What are the key indicators? What are you doing with the money? What's the collateral they have in case something goes wrong? That there really is a whole engine behind the salespeople and the CEOs of these companies, that your story better be tight and it better be attractive, because there's lots of people every morning at their doorstep looking for money. So have a really clear, crisp, numbers-oriented story about why this is a win for them and a win for you. This gentleman right here.
I was curious, how does your debt financing model play into non-SaaS verticals like more regulated, longer time horizon vertical within DSW?
The question was, how does it work outside of SaaS in either other environments or other industries or particularly regulated industries? So we work with fintech companies, we work with consumer product companies, we work like Athletic Greens, Roman Health, or now Row Health. We work in healthcare, we work with gaming. So we're not, we don't like read your contracts. We don't dig too deep on what your product is, like just because of the nature of what we do, we're just purely doing math. So in a regulated industry, we'll think about it the same way. Like, what are you spending on sales? How many customers are you acquiring? How long does it take you to get paid back? Do we feel comfortable with the risk? If you're in an industry where you're selling to one government customer, like it's not for us. Like that's just not where we play. But we're not at all picky based on industry. We actually have a mandate to try and diversify the different companies we work with. I think, that just not to get like too history focused on all this, but if you think about the evolution of business models, go back 50 years, people spent to acquire a customer, but they got paid up front. Like, so it was a perpetual license, it was a product, whatever that might have been. People sort of designed their businesses to generate cash flow quickly, and then all of a sudden, as like different forms of financing evolved, people started to realize that you don't have to make money every month. Maybe there's other ways to grow. There's other forms of capital that can allow you to not have to do that. And then it got to sort of this ultimate point where VCs in particular started to say, like, what if you don't generate money at all because we can just focus on the terminal value? And by terminal value, I mean like ultimately what you sell your company for, what you come back, because that's also a cash flow. And so instead of focusing on all of the immediate cash flows and running my business super tightly, they said, let's maximize that. And let's drive the return on that. And so what that ended up doing was like, it kind of had this interesting shift, and I said, well, how do we maximize terminal value? We maximize terminal value by having a lot of customers. So how do we get a lot of customers? Well, let's lower our price. Because if we don't need to make money now, we can lower our price. Well, that was kind of tough, but they said, like, well, what if we lower our price, but we keep charging people over and over and over again? And so that's kind of like, there's been this evolution towards these lifetime value style investments. And so most businesses in most industries have now adopted this idea that I can expand the market that I go after, the number of customers that I acquire, the ultimate people I can reach, if I have a pricing model that makes the cost of entry for that customer less, right? Like if I have to pay less upfront, if I'm, I was paying $1 a month for my Google Photos account. It's probably up to $5, and I'm not even sure why, but that was so easy. But they're getting from me $60 a year, right? And then over 5 years, that starts to look a lot better in terms of how much they got from me, and I would have never paid them $300 up front, right? So I think that it's certainly not true of every industry, and there's certainly certain things, particularly around the government, that have a slightly different model. But most business today has some version, once they've hit a certain scale, of a trackable lifetime value, and so that's kind of how we fit into the picture.
So before I ask for any more questions, I want to ask this hard question. I'll come to you right next. Debt can be a 4-letter word. It sometimes doesn't work. It doesn't work for you. It doesn't work for the company. And lots of people will tell you never borrow. Could you each just take a minute before we go back to the audience and tell us when it didn't work, when you didn't get a return of your money or a return on your money? What went wrong and why, without saying any names?
Yeah, we've been fortunate that we haven't had any massive blow-ups within our portfolio. So I mean, when it didn't work, yeah, we certainly had companies that have had challenges, and it predominantly comes down to two things: the growth, either they get off plan, right? And it's hard for us to underwrite to a plan because it's just that it hasn't happened yet, and we're not as optimistic as equity investors. So if we're gonna haircut that plan, and so when someone really falls off their plan, even though you haven't necessarily lent against it, maybe they've already spent the money because they thought they were going to hit plans. So the two core components of the plan are the revenue plan and how you're going to manage cash. And so I think those have been the trickiest. And if churn happens, any material churn can bump you off plan that you didn't expect. I think there's been a lot more unexpected churn the past 24 months than there was the prior 120 months, let's just say. So folks having to recalibrate and adjust to that, tighten the belt. For us, we're not a throw the book lender. I would say lenders of various sorts, and we're different sorts of lenders. We've got a loan agreement. It's got a lot of stuff in it. It gives us a lot of protections, but we're also trying to grow a business, trying to have a brand. We're not trying to just loan to own or go shut the door on someone because they tripped a covenant. A covenant would be something that you have to adhere to in a loan agreement. A minimum cash balance maintained, a certain revenue growth rate, whatever it may be. And again, those are generally going to be sized with the plan that we're taking in. So, hey, you probably don't have to hit 100% of that plan, but hit 75% of it, right? Give you some buffer. And so we've had to work through some of those situations. I think, frankly, what's really important there, again, don't lend money to companies that are too early on in their revenue cycle. Don't back companies into a corner. The way we would back companies into a corner is by lending them too much money. So over-levering them, as it would be called. So we're extremely sensitive to that. Doesn't do anyone any good. We lose deals because of it. Oh, well, you're going to give me $1 million? They'll give me $2 million. I didn't even think we were talking about $2 million. Can your company even support $2 million? Okay, fine. If you want $2 million, go there. So yeah.
Yeah. So I think part of the reason, if you step outside the technology industry or the general venture capital industry, you wouldn't even have this conversation. So those businesses have to fund themselves with a variety of different capital sources because they just don't have all the same options available to them. You're not going to go to a mid-stage consumer products company and find them spending equity on all of their inventory and financing all of their receivables. You're not going to go to a manufacturing company and find out that all of their equipment was bought without a lease, right? You're going to these sources of capital and options have existed in all of these other industries for almost ever. So I think what's happened in technology is one, VCs are probably the most successful marketers of the last 50 years. They've sort of offered this blunt force instrument of equity and said use it for everything and worry about everything else later, and let's celebrate you raising it. Well, there's a lot of countries, there's a lot of cultures where if people found out you sold a percentage of your business, they're calling you up to ask if you're okay, right? So it doesn't mean, it just means you have to be aware that there's examples of this that exist and for good reason. The thing that you have to watch out for is the asset liability mismatch. So as we just talked about, it's this idea of over levering, but essentially borrowing something with a payback timeline without any sort of like asset or ability to pay that back within the timeline that you're expected. What we saw was that, sales and marketing itself, which is where we focus, had performance variability. So while you create like a predictable structured return, you have bad months and you have good months. And so what we realized was that if we asked somebody to borrow all of their sales and marketing spend, and then they had 3 bad months in a row, but they had to pay us back, well, that could sink the entire company. So nobody in their right mind was kind of gonna do something that risky. And so, we don't actually think of ourselves as debt because we flip the risk from the company to us. And we realized that if we got really good at underwriting and we held the risk, that solved that asset liability mismatch for the company. And so what we recommend is as companies get to a certain stage is that they should explore all of the capital sources available to them, and that they should think about their total cost of capital to ultimately increase the value of their equity and maximize that. So they should explore debt where it makes sense and they have like structured, predictable paybacks. They should explore us where they want to take some more risk, but they still have some type of structured return, like customer paybacks. And then they should use equity when they're building a new product or they're entering a new market where there's a lot of risk associated with that decision and the payback timeline's not that clear. But if you're sort of taking taking on a liability to go do something with risk, well, that could end up poorly for your company. And so, like, you have to make a lot of decisions throughout that process.
So when you take away from a VC, often they'll get a board seat, but they'll have some sort of influence over the company over its lifetime, right? It might take 10 years for them not to get money back, but they'll have influence over that. Do you have anything post giving as well that you say, like, we want metrics and this month we want some sort of influence, some sort of peace of mind that might expect how we think it should be spent?
Yeah, we don't take board seats. We certainly have monthly reporting requirements. And so for us, and as Roy probably does as well in some form or fashion. So for us, we build software internally. We have people connect to that software. We get read-only access to banking and accounting systems. Like, we want to be as real-time as we can be with the cash at the end of the day and understanding what's going on with that. It's like, hey, if we're informed, we're more comfortable. It doesn't mean we're not going to ask you questions, but like, you should want your capital provider to be informed. And I think oftentimes we're more informed in a real-time format than their equity investors who get together for a quarterly board meeting. So, but yeah, we don't take board seats, and even a board observer seat. I guess I have seen a handful of lenders take a board observer seat. I don't think I've ever seen a lender take a director seat on a board. But yeah, reporting requirements are going to be standard for most lenders like ourselves, which are senior secured lenders.
Yeah, we're again a little unique here. So we make a point of, like, we don't opine on strategy. We don't think we're trying to pick the next Steve Jobs. Like, we're just doing math in the background, seeing if it works. So we definitely won't take board seats. We will make a commitment to a company that we will fund for a certain period of time. We fund month by month, so we're not giving you all of the money up front. We're giving the money as you go to spend it, to try and align with your cash flow cycle. And so we will track performance of the various cohorts, and we'll have thresholds. And if thresholds, or if the performance starts to dip, we'll have a conversation about whether it makes sense to fund future cohorts or not. The one thing we'll never do, though, is pull money back when you're not getting paid by a customer, because again, we want to stay totally aligned and own the risk on that part of the performance.
That's a great question, by the way. We have 4 or 5 minutes left. I'm curious if anybody else has a question they want to ask our panelists. Wow. Let's go to the gentleman in the black shirt back there.
Do you see that most businesses are using debt to bridge to more favorable equity terms or to reach some kind of cash flow escape velocity? And do you compare what
Yeah, so we don't think of ourselves as a bridge lender, and there are bridge lenders within software, within real estate, within multiple sectors. And so, but that said, what we've seen historically speaking, we're always bridging to something, which could be future generation of consistent cash flow. Could be an equity raise, could be a sale of the business, right? And so what we want to try to figure out when we're entering a situation is, what are you trying to do? Where are we mutually trying to get here? How much money do we think it's going to take? Are we the only money in the mix? Is there other money in the mix? And how reasonable is, if you say, hey, I'm getting to my Series B and I'm doing $3 million in revenue and I'm growing 20% a year, it's like, no, you're not. That's not happening. So, yeah, there's a lot of bridging going on. I think you have to, as the lender, assess, how stable and sound and viable that potential bridge is. But, we certainly have played that role and will continue to play that role.
Yeah, I think it's no secret that the equity markets have shifted, and people are starting to be more creative about how they think about sourcing capital. I think the other thing that we see a lot of is just like a pullback in spend and aggressiveness from many of the companies we're talking to, have all sorts of opportunities to invest, but don't want to be in a situation where they need to raise capital. And so everybody's kind of making their own decision. For us, it's helped a lot because people have gotten more thoughtful about how they structure their business. But that definitely goes on. And I think even in good markets, it still happens. Like, you want to control your own destiny. Equity is expensive. The less you have to raise, the better ultimately. But you also don't want to miss opportunities. So it's always a trade-off.
Yeah, so the question was, are these bridge lenders? And the answer is, they're bridges to somewhere, right? They're bridges to the next equity round, to the next acquisition, to saving cash, to doing something, opening in a new market or new product. But they don't call themselves bridge lenders, but they're definitely a bridge to somewhere. So we have time for two more questions.
Let me add one point to that Roy already hit on the concept of enterprise value. I think we're both trying to help you drive enterprise value growth in a fully non-dilutive way.
Can I see a show of hands of all the people that want to ask a question? I'm going to pick two of you and then close. So I'm going to go to the students, and then you'll be next, and then we'll close. Yes. Repeat the question.
Yeah, so the question was, has there been a time when you're really unsure, should you invest in a company, and what do you do? I would say always. I think there's always doubts about everything that you're looking at. And when I, before I was the CEO of Life Factory, I was actually investing on the equity side. And I think that happened all the time because you're taking sort of this flyer on the upside. Do you have the right people? How do you make a decision? Do you have enough information to trust your gut? And how do you then decide that, yes, I'm going all in here? And a lot of what I focused on was, there's always going to be things you're unsure of in a business. What are the things, can you circle where you think the biggest challenges are and then decide if you can be helpful? And so can I help somebody get through the specific things that I think are going to be hard for them? And then that would make me a good investor for that company. With what we do now, we're very picky with who we work with just by the nature of the products. So it's a little bit of a different, but I would use that example on the equity side.
Okay, one quick question, then we're going to wrap this up, and we'll all be available to talk afterwards. Yes, please.
So real quick, if you're at the stage where you're looking for seed funding or something like that, you're going to go out and ask for that within 6 to 12 months. What are some of the KPIs that you would recommend to really hammer on and nail for that vision?
Yeah, so the question was, if you're going out to raise seed funding, what are some of the KPIs, and what should you be focused on? I would say, again, seed funding has a pretty broad definition. A lot of people that are investing at that early stage are doing so based on conviction of the person over specific traction. Obviously, traction helps. Obviously, customers help. Obviously, revenue helps. But the thing that I think about is there are people you can hire that will do what you tell them. There are people you can hire that will do what you tell them well. And then there are people that you hire that will just do things without you telling them. And they'll do those things well. And the founder is the ultimate person that has to do things without being told and create when there's nothing being done. And so what I look for at the really early stages when I was doing that was more of this bias towards action, people that just do and just create. And so every time I checked in with them, something new was happening, a new idea was there, progress had been made, new projects were started, new customers were added. And so I think a lot of what people are evaluating at that stage is really you. Like, the idea does matter, but are you making progress? Are things happening? Or are you just waiting for somebody to help you?
Great. So I want to thank Eric for inviting us to do this. I want to thank Denver Startup Week. And I want to leave you with one more thing to write down for those of you that are taking notes. And this is one of the KPIs that I have learned in operating businesses and getting equity and debt from others. So in addition to everything they talked about, the narrative, the total addressable market, the revenue, cash, investors who are giving you equity or debt are looking for the 4 Qs. Your intelligence quotient, how smart are you? How quick of a learner are you? How fast are you adopting? How fast are you pivoting? Your emotional quotient, your spidey sense, your ability to read the room, the soft part of being an entrepreneur, your ability to get the right people to understand your dream. And your UQ is your uncertainty quotient. Can you deal with COVID or interest rates or politics or your partner leaving the business or something happening? What happens when there is uncertainty, and there is often uncertainty? A lot of people just collapse when there's uncertainty. And so that third Q is really important. And the last one is adversity quotient. And that is your resilience and your grit. When something goes wrong, the product doesn't work, something happens, can you handle the adversity? Can you get up? Can you fight for another day? So entrepreneurship is awesome. It's scary, it's challenging, it's interesting, and we encourage you to do it. And if you need to borrow money, call these 2 guys. Thank you very much.